Hi guys, I'm Big Mike, and like always, I'd like to thank you for being here today. Today we've got Ernest Chan doing a presentation on capital allocation and risk management, a large portion of which will be focused on the Kelly formula. I would consider this an advanced topic webinar, so you've been forewarned. Ernie's a managing member of QTS Capital Management, and he's worked for various investment banks and hedge funds over the years, almost 15 years in fact. He has a PhD in physics from Cornell University and was a member of IBM's Human Language Technologies group before he joined the financial industry. He's also the author of Quantitative Trading, and I don't have the book myself, but the reviews on Amazon are very good, and I have heard that if you have or use MATLAB in particular, there's a lot of excellent sample code in the book for MATLAB. So today I'll be turning things over to Ernie in just a minute, but we're going to be giving away 5 autographed copies of his book, Quantitative Trading, and it's very important that you pay attention to the webinar so that you have a chance to win one of those books. As we go through the presentation, he's going to be asking some quiz questions. The first person to answer the quiz question will be the winner of the book. You can win 1 book today, and we're going to give away a total of 5. And in order for me to get in touch with you to get the book in your hands, I will be asking the winners for their BMT username. So if you came to this webinar through some other means other than Big Mike Trading, then you need to go to the website bigmiketrading.com and register a username. It's free. It takes less than a minute. That way, if you are one of the winners, you can give me your BMT username, and then I'll get in touch with you after the webinar in order to get the books or the book in your hands. All right, guys, give me just a minute, and I'll be turning things over to Ernie. As you guys have questions, type them into the box there, and I'll do my best to get everyone's questions answered today, or Ernie will at least. All right, guys, hang on one second. Here comes Ernie.
Hello. Thank you very much, Mike, for your introduction. Let me make sure that is everybody able to see my presentation on my screen?
Yes, we can hear you, and I can see it just fine. Thanks, Ernie.
That's great. Thank you very much for coming, guys. So let me just start right off by telling you what exactly is Kelly formula. It's 3 things at once. It's quite a wonderful formula. The first use of Kelly formula is risk management. The theory, and I emphasize theory, is that if you adopt the Kelly formula, you will reduce or even eliminate the possibility of losing all of your account equity due to cumulative trading losses. Now, I emphasize theory because there is an assumption in this implementation of the Kelly formula, and which is that the stock returns or whatever instrument returns are Gaussian. We will talk a little bit more about that in the future. But if stock prices and stock returns are well behaved, as in a Gaussian distribution, then Kelly formula tells you that by adopting this method, you will not go to 0 equity. Now, of course, we don't want ever to even lose a substantial chunk of the money, not to mention lose it all. And I will tell you a little bit a additional scheme where you can apply for which, when combined with Kelly formula, you can control the maximum drawdown and not to let it go to any arbitrary number you designate. The second use of Kelly formula is leverage optimization. And that is, oftentimes we are faced with a good trading strategy, but we are stuck with the problem of, what proper leverage should we apply? Is it going to be is 1 or is it 2? Kelly formula tells you a very formulaic way of computing the proper leverage. And what this proper or optimal leverage implies is that if you adopt this leverage, you will be able to generate maximum compounded growth of your portfolio equity. So this is the best you can do. In other words, if you adopted leverage, not only will you not have the risk of losing all your equity, but you will maximize the potential compounded growth of that strategy. And then finally, the third use of Kelly formula is optimal capital allocation. That is, if you have multiple strategies, Kelly formula will tell you what is the relative leverage between these strategies or between these portfolios. So it gives you the optimal overall leverage, but it also gives you the optimal relative leverage amongst the different strategies in order to create a maximum growth of that portfolio. So, and by the way, please feel free to ask questions as I go along, because some of these concepts can be rather difficult. So, it's better if we go along and understand every one of them.
Hey, Ernie, I mentioned that I'm not a math major, so I'm probably gonna make some or ask some embarrassing questions. But you're talking about leverage here. I want to first understand. Futures, for example, are already a highly leveraged instrument. So do we ever use like the margin requirements as part of factoring the Kelly formula leverage? How does that work together?
Mm-hmm. Yes, in the case of futures, we define leverage as the market value of your position, so the notional amount divided by the actual account equity. And that actually applies to whether you're doing futures or stock. It's always the gross market value divided by the account equity. So if you're you're trading a future that the notional amount is $100,000, even though you are required to have a margin amount of maybe $10,000. If you have $10,000 in the account and you're trading this one contract which has a notional value of $100,000, the leverage will be 10. And however, Kelly formula might tell you that but Kelly formula might tell you that it's not a good idea to use this minimal margin amount in your account. It may ask you to actually put deposit $20,000 instead of just having $10,000 in an account, just for the safety sake. Otherwise, Kelly formula might tell you that you could well lose all the $10,000 equity, and
right.
we'll be done. Right.
George asked the question, and hoping that we're not going to interrupt you too much here, but we're going to try to get the questions as they come in. Kelly formula is developed with the assumption of a random market with a Gaussian distribution. Do you think that assumption holds?
That is a very good question, and that is the main caveat on Kelly formula. Yes, it does assume Gaussian distribution of returns, and we all know that the actual financial prices are not Gaussian. Occasionally we are surprised by how much the market can drop in a day. For example, in 1987, I think it dropped 20 or 21% in a day.
Right,
right after September 11, then we had a 3-day market close, and then it dropped. I can't remember. Well, north of 10%.
Right, and Jason makes that point. He's saying as a misrepresentation of kurtosis distributions was a cause for poor risk management prior to 2008. Has anyone adapted this formula or other distributions such as mixed Gaussian or student T, etc.?
Yes, well, that's a little bit complicated, but let me first answer the first question properly first. The issue, however, is that you can have a much more sophisticated way of applying Kelly formula without assuming the Gaussian assumption, without the Gaussian distribution. Actually, the fundamental gist of Kelly formula is independent of Gaussian distribution. However, there is no analytical solution to a simple leverage formula if you don't assume a Gaussian distribution. So what I have done, and actually this is some stuff that I have written in my new book that is coming out, a little bit 6 months from now. You'll see that you can get rid of the Gaussian distribution and just adopt a, let's say, Monte Carlo distribution, Monte Carlo sampling of some kind of distribution with kurtosis or with whatever strange distribution that you like, and then find the optimal leverage based on this kind of sort of brute force method or Monte Carlo method. What I found, however, is interestingly that the two methods, whether you assume Gaussian distribution or not, actually give you a very similar leverage estimate. So, despite all this caveat about, non-Gaussian distribution, it turns out that the estimate for leverage is fairly robust. It seldom overestimate the leverage so much that even, in the face of a non-Gaussian distribution, it will actually lead you to ruin. So I think that is one of the beauty of, credit formula.
All right, one final question for now, and then we'll move on. Mr. Pelt says he's often wondered, take a trading strategy or a methodology, can money management or risk allocation turn a trading methodology that overall on balance is losing money into something that is profitable? And by that he means, imagine that the strategy is trading one contract, for example, on futures, and it's losing money over time. Can various money management schemes turn that into a profitable question or into a profitable strategy?
The answer is no. In credit formula, I will show you a very simple, form of the credit formula. Actually, the next page gives you that. It is simply equal to the average return divided by the variance of return. So if your average return is negative, by that you mean a losing strategy, the leverage will be negative. So that means that you should be trading the opposite of that strategy. So that is a simple way of saying that there's no way to turn an unprofitable strategy to profit.
Kelly is simply about the risk management. It's not telling you where to set your target or your stop. It's just telling you how much to bet, right?
That is right. Yeah, that is right. So moving on to this simple formula, if you have one portfolio or just one strategy, and you have an average excess return of M. Now, excess return means that the return of the strategy, the unlevered return of the strategy minus the risk-free rate. Okay, so financial researchers always like this excess return notion. And if you have the standard deviation of this excess returns is S, then the optimal leverage, which again is defined as the gross market value divided by the account equity, is simply M divided by S squared. Now notice that this looks very similar to what people call the Sharpe ratio. The Sharpe ratio is M divided by S, but here we are M divided by S squared. And one thing to be be very careful is that this M has to be the unlevered return. So as Mike alluded to earlier, if you have a future contract, the unlevered return must be the notional market value, the gross market value divided, the P&L divided by the gross market value or the notional value of the contract. Okay, so it is not the P&L divided by your account equity. That would be the levered return. Okay, so this is very, simple enough, this formula, and anybody can compute that. You don't need a computer. But actually, the most important point that Kelly formula makes is that you have to keep your leverage constant at this value. No matter what value it gives you, you may be able to estimate a better optimal leverage by using Monte Carlo simulation, or you can use some fancy analytical formula with a kurtosis assumption. Whatever you use, maybe it's more complicated than this formula that I presented to you. But the main idea is that once you computed that optimal value, you have to keep your leverage constant. And this sounds simple, but in practice, it can be quite counterintuitive, and I will show you why in the next example. So let's say we have 100 grand in our brokerage account, and through some method, or using my simple formula or using some other complicated ways, you have computed the Kelly leverage, the optimal Kelly leverage, to be 5. So what that means is that you should be trading a portfolio with market value of $500,000. Okay. Now, let's suppose in one day, next day, you start trading, and you lost $10,000. Okay, at the end of the day, you find that you have lost $10,000. So naturally, your equity is reduced to $90,000, and correspondingly, your portfolio market value is now $490,000. Okay, so what the constant leverage requirement of Kelly formula tells you is that you have to liquidate a further $40,000 of your portfolio. Now that is the somewhat counterintuitive point, because a lot of people think that, well, I already lost money. Why should I liquidate my portfolio further? You know, I should be sort of taking, you know, buying on the dip, so to speak. But that is not sound risk management. Risk management tells you that if you are levered and you have lost money, you need to liquidate further your positions in order to protect your equity. So what that means is that, you know, if you have to so based on this 5 times leverage, you have to liquidate $40,000 of your portfolio, so that its updated market value is 5 times your new equity value of $90,000. So the new target portfolio market value is $450,000. Remember, if you don't liquidate this $40,000 worth of portfolio, your market value will remain at $490,000, and that would be over-levered. You know, Kelly formula advise you not to over-lever. You have to sell $40,000 of the portfolio in order to keep your leverage constant. So let me pause for a moment and see if there are any questions.
Well,
let's see if anyone has question on this example, because this is kind of important and it might be confusing. So let me know if anyone is confused about this procedure. No? Okay. So moving on. So this example trade, the fact that Kelly formula always asks to reduce capital at risk, or in another word for portfolio market value, when you incur a loss. Okay, and that is assuming, by the way, that's assuming that you are levered at greater than 1. If you are unlevered or you are under-levered, then you know, you won't have to do this reduction of your market value. Okay, so if the optimal Kelly leverage is 1 or less than 1, it wouldn't ask you to sell. But on the other hand, if it asks you to, if your optimal Kelly leverage is greater than 1, then yes, you will always be asked to sell into a loss.
right.
And if you do this type of risk management, there will be, Kelly promise you that there will be a vanishing probability that you will lose all your equity.
So there's a few questions. Let me try to catch up here.
Okay.
One question is, can you give a real-life example as to what would be the calculation in a portfolio that trades one contract each of oil, silver, gold, and the yen? I think this is too much for you to do right now. But is there maybe like an Excel spreadsheet or something out there, or maybe something on your website that people can plug in numbers and find out the answer to that question? Like this gentleman wants to know what his optimal F would be on a portfolio trading 4 different futures contracts.
Okay. Actually, it's very easy. You just need to look at this formula. You know, no matter how many futures contract you trade, you have to ask yourself, what is the average return? Let's say annualized. You know, it doesn't matter if you are annualized return or daily return. This Kelly formula is sort of invariant with respect to time scale. So you can use annualized return. So if the annualized return of that trading strategy is you know, 20%, just put 0.2 in place of M. And you also need to ask, what is the variance of the return of that portfolio? Okay, and it might well be 20% again. Okay, then in that case you put 0.1 in place of S. So the leverage will be 0.2 divided by 0.2 squared.
And the notional value has to be, we have to take all 4 futures contracts notional value. Where does that come into play?
That is right. When you compute the 20% return, that 20% return is
based on the notional value by the account equity, right?
That not the account equity. No, the the M, that 20% is the unlevered return. So it will be whatever P&L you get in dollars divided by the gross market value of all 4 contracts.
Gotcha.
Right. Yeah.
I'm a little slow with this. Hopefully others are following it.
Okay. All right. Is there any other question on this?
I think we could go ahead and move on, and I'll ask questions later.
Okay. All right. So the reason, as I emphasized, that we have to do this sort of rebalancing or selling into a loss is to protect your equity, so that there's a vanishing probability that you will lose all your equity. And also, at the same time, this optimal leverage is going to maximize your long-term growth. Now, what does that mean? Well, actually, there's a very simple proof for that. If you are patient with a little bit of mathematics, I can show you this, basically one line of proof. And the reason is that if you are assuming a Gaussian distribution of returns, and if these returns are levered at F, okay, with an unlevered mean and standard deviation of M and S, the formula for this compounded growth rate of a portfolio is simply G equals to the leverage F times M minus S squared F squared divided by 2. So trust me, this is the formula. I won't derive this formula for you, but this is the formula for the compounded growth rate of a return series that are of course randomly distributed, but it has a Gaussian random distribution, and it has a mean of M, and it has standard deviation of S. And if this random return series has these 2 characteristics, mean M and standard deviation S, then the compounded growth rate is going to be given as G of F as displayed. And if you have this formula, then it is very easy to say, well, then what is the maxima? What kind of leverage F will maximize this compounded growth rate? And based on first year calculus, you take the derivative of this formula with respect to F, and you find that the maximum occurs at F equals M divided by S. Now I find a typo. Let me immediately correct this typo. I need to have a square there. Well, it won't go up, but anyway.
there's a couple of questions regarding the prior slide about rebalancing. So both JP and Lucia ask, let's say that they're trading primarily an intraday strategy, so they're flat at the end of the day. They're not swing trading. They're not carrying over. How often should they be rebalancing? Lucia says, at what frequency do you recommend rebalancing your portfolio to keep your leverage optimal? Even at minute-level frequencies, he finds that the transaction costs erode the return, and it's one of the things that Shannon's original arguments were made against the Kelly criterion. So you have to take into account commissions, possibly slippage as well. Is this just something that you just run the numbers, or do you have a recommendation on how often you should be rebalancing the position?
Well, it depends very much on the, this is really a practical question, and I find it depends very much on the level of leverage. If your leverage is not high, let's say your leverage is only 3, the change in the day-to-day, the rebalancing is going to be small. So even if you're going to rebalance every minute, there's not too much stock to sell. So, I don't feel that it has any big benefit.
It wouldn't be practical. Change. Right.
Right. It's too minimal. Now, of course, if you are levered at 50, as some forex trader might do, then the minute-to-minute P&L might affect your equity substantially, and you do need to rebalance, quite often in order to reduce the risk. So, the frequency of rebalancing has something to do with the leverage that you are deploying. And for me personally, I nowadays I seldom trade anything with a higher than 5 times leverage, and I feel very comfortable just rebalancing at the end of the day.
Okay, thanks.
Yeah. Okay. So moving on, here is the first quiz question. Okay. Now remember, the previous example, we had a portfolio where we started out with $100,000 equity, and the portfolio market value is $500,000. That $500,000 might be the notional value of the futures contract, added together. And I said that we lost $10,000 in one day. So the market value of the equity was reduced to $90,000, and the portfolio market value was reduced to $490. But after carefully rebalancing, we reduced the portfolio market value to $450,000. Okay, so that was what happened at the end of the previous day after rebalancing. Now, suppose you make $20,000 the next day. Okay, and what should your portfolio market value be? What size?
Okay.
Trade.
So we have answers coming in. I'm going to just read them out, and Ernie, just tell me the first one that's right. Greg says 600. Thomas says 550.
That's right. 550 is right.
So congratulations, Thomas. I need just type in your BMT username, please, and I'll get in touch with you after the webinar to get that book in your hands.
Okay. Let me explain why 550 is right. That is because you started with an equity of 90,000. Now you made $20,000, so the new equity is $110,000. With an optimal leverage of 5 times, the optimal market value would be 5 times 110, so that would be $550,000. In other words, you have to buy an extra $80,000 worth of securities in the portfolio. So a carry formula doesn't always ask you to sell into a loss, but if you make money, they will ask you to borrow money and buy more stocks. Okay, so that is the opposite of what happened in the first example. Okay, so but yeah, actually, before I go on, is there any question about why or confusion about why it should be $550,000?
Sure, and let me also clarify. I see a couple of questions. So we're giving away 5 autographed copies today of Ernie's book, Quantitative Trading. So that's what corresponds to each quiz question. So Thomas, if you want that book, then I still need your BMT username. Okay, there we go. All right, are there any questions on this slide, guys? Kevin says, wouldn't it be more risky by buying more shares after the 20,000 increase?
Well, no. The answer is no, because remember, carry formula doesn't just want to decrease risk, but if it's only a matter of decreasing risk, we should be all unlevered and trade at one minimal risk or maybe even underlevered.
Right.
But at the same time, carry wants you to achieve maximum growth rate of your equity. So you have to maintain a constant leverage and if you maintain constant leverage, you will have achieved the optimal balance between growth and risk.
Right, gotcha. George is asking, how do you determine the leverage of options strategies when the delta neutral approach, such as butterflies, or with a delta neutral approach like butterflies or back spreads?
This formalism, this kind of formula, it doesn't really care what what underlying instrument you trade. So if you are trading options, the only question we have to ask is, what is the market value? Okay, so the market value, if you are, for example, long options, you might consider it just the premium of the options itself and divided by whatever account equity you have. On the other hand, if you are short options, you can consider the market value of the risk of your portfolio. Okay, so the crucial question is not the details of your portfolio, but exactly how you're going to calculate an unlevered return. So that depends on how you think is the unlevered return is in the case of a complex option strategy.
Right. Okay.
Okay, so let me continue on to the next slide, and that is sometimes a confusion that a lot of traders have, and that's the distinction between continuous and discrete carry. A lot of traders are very familiar with the notion of carry formula, but they are familiar with the discrete version. That is to say, it is almost like in a game of gamble rather than trading. We make bets that have two discrete outcomes. Are you winning or are you losing? Now, if you win, let's say $1. If you lose, you could have lose everything that you have. That is a sort of a discrete betting, and there is a Kelly formula for that, but that is not particularly useful for finance because if you are really involved in gambling, making bets rather than trading, there is always the possibility in one bet losing all of your equity. And in that case, you should always bet less than your total equity. So in that case, the leverage must always be less than 1, because if your leverage is 1, you either win all or lose all, and that's not good. The Kelly formula wants you to preserve your capital so that you can always win back, in the next time. So that's why a lot of times traders find that, well, how can I bet more than what I have, in finance? Why if I have $10,000, why should I leverage it to trade a $20,000 portfolio? Whereas, oftentimes people say Kelly formula said you should only bet, 80% of your equity or 60%. But that's because in the case of making discrete bets or in gambling, you have the chance of making one bet and lose it all. But that is never going to happen in finance, or seldom going to happen in finance. The stock is unlikely to drop to zero, in one day unless it goes bankrupt. So there are some extreme cases. But if you have a Gaussian return, again, you're assuming Gaussian return, and you have a diversified portfolio, you might lose 10%, 20%, or maybe even 30% in one day, in some extreme circumstance, but it's not going to lose 100%. And in that situation, we are going to apply the formula that I talk about, which is applicable to continuous outcome. And in that case, you can bet more than your equity. You can leverage it greater than 1. If you have $110,000, you should be able to bet more than $10,000. So that's the sort of the difference between the way I'm using Kelly formula and a lot of times when other people were discussing Kelly formula in the discrete betting case. So let me pause again for a moment to see if any question about this distinction.
There's not any questions, I don't think. Actually, hang on, one just came in. How does Kelly come into play if you have multiple strategies and the strategies share some correlation between them? For example, a momentum strategy. I think maybe he's talking about different strategies on the same instruments, or in the futures world, maybe if you're trading index futures, they're pretty highly correlated. Do you factor in correlation with the portfolio in any of this?
Yes, we definitely have to factor in correlation, and that is actually forming the last part of this presentation. I will talk about capital allocation, and that is going to require a more complicated form of Kelly formula that incorporates the covariance between the different strategies. So okay. I will come to that in a few slides.
Okay, great. All right, that's it. There's no other questions right now.
Okay, so now in practice, a lot of traders would use what is called a half Kelly. So if you use this F equals M divided by S squared formula, and you come up with let's say 5 times leverage, many traders would say, let's just use 2.5. Divide this Kelly leverage by 2. And the reason is that the return and the variance of returns are all estimates. You have a finite amount of data. It can change. Your estimate cannot be very accurate. Maybe based on 1 year data, maybe 3 years data, but it's not going to be accurate. So there's this uncertainty in the estimate, and so it's safer to be on the under-leveraged side than to be on the over-leveraged side, and that's one reason. The other reason is that whatever estimate you get, no matter how long a historical data you have that you use to estimate the M and the S in calculating F, the future return and the future variance of return may not be the same. So that is one problem with finance, is that the past doesn't always portends the future. The future return may not be the same as past return. So again, to be on the safe side, we always divide the leverage, the optimal leverage recommended by Kelly, by 2 when we applying to a practical strategy to avoid over-leveraging. And the reason is, there's a lot of analytical work done on Kelly formula which says that if you are over-leveraging, if your leverage is actually higher than the optimal for the future return and the future standard deviation, you might go to ruin. Your equity might actually go to zero. But if you are under leverage, it will never go to zero. It might not maximize the growth rate. It might not have as high growth rate as you like, but at least it would not go to ruin. So it is always safer to be on the under leverage side than on the over leverage side.
And you're mentioning ruin, Ernie. You might remember a few months ago, whenever we first set up this event, I sent you a thread on the risk of ruin, and some of the guys in the forum did a lot of work. Basically using trade expectancy, taking both the stop and the target into account, and I think it was half Kelly trying to come up with a formula to compute like a risk of ruin. So, Kelly's for bet sizing. You mentioned that you have another book coming out. I'm wondering, do you have an opinion on a preferred method that takes into account, a stop placement, like how much equity is actually being risked on that particular trade based on where your stop is, and also takes into account the target, how much your potential reward is on that trade?
Well,
it's not going to be Kelly, but I'm just wondering if you have a preferred method for that.
Actually, that falls, you could say that falls under the heading of parameter optimization, because the stop loss and the profit cap, these are two parameters, right? So for every strategy, you could say, well, let me implement a stop loss and let me implement a profit cap, and you can use historical data to optimize these two numbers. But there are two problems with this. Well, the first problem is that for mean reverting strategy, it's seldom optimal to have a stop loss. I have never seen a stop loss generating an optimal, for being the a non-zero stop loss being the optimal value for a mean reverting strategy. On the other hand, for a momentum strategy, it's seldom optimal to have a profit cap.
Gotcha.
And so that's, in general, a problem.
Right.
The second problem is also that whenever you're trying to do parameter optimization, the past seldom predicts the future. So you might think that there's precise value of stop loss that worked very well in the past, and it's easy to optimize this kind of value for the past. But the problem is that it's seldom true in the future. Unlike Kelly formula, where the past oftentimes is a little bit more robust, where you don't have to estimate it completely accurately in order to get close to the optimal growth rate. So Kelly formula has this virtue of being a little bit robust with respect to errors in the estimation, whereas the precise value of stop loss and profit cap are very sensitive to the data that you use.
So just so I can better understand what you're doing, you mentioned that you're primarily trading stocks. Are you an intraday trader, or do you swing trade? Do you hold positions for many months at a time?
Well, I was primarily a stock trader until 2010. Okay, so at that time, I do trade in intraday. I seldom hold stocks position overnight.
Okay. So if you have a basket of stocks, let's say there's 10 stocks that you're trading in, you decided that you want to be long, half of them and short the other half. Were you rebalancing that position during the day? I mean, were you constantly, as it went against you, if you're long and it's dropping, were you taking off shares, and then as it went with you, were you adding shares back? Is that something that you did throughout the day?
No.
Only at the end of the day.
Yes, only at the end of the day, and because you have a choice of using Kelly formula to run every stock separately, like as a capital allocation formula. You can do that, but there are two ways to look at it, because sometimes you have a trading strategy, a long short strategy that determines what the capital allocation is. regardless of what Kelly formula knows. Because Kelly formula is kind of dumb. It only knows the correlation between the stock returns and the standard deviation, the return and the mean. But if your strategy, pretends that it knows more about the characteristic of these stocks than the simple Gaussian assumptions, then it can make a better capital allocation. In that case, you can still use Kelly formula to determine the overall leverage of the portfolio. You don't have to use it to determine the individual allocation amongst the different stocks.
Gotcha. We're clear. I see a question coming in. If you have 30 instruments in a strategy, do you apply the Kelly formula to each instrument, or do you apply it to the entire portfolio and then take the mean return and the standard deviation of all instruments for the calculations?
Yes, actually, that's the question. It's pretty much the same answer as I just mentioned. Usually, if you have a strategy for, usually if you have back-tested a strategy assuming certain capital allocation among the different stocks, let's say equal capital allocation or some other fancy allocation that your strategy determined, then you should follow that allocation. You should not apply Kelly to determine the individual stock allocation, because Kelly is kind of dumb. Like I said, it doesn't know very much about these stocks except its historical covariance. But you should just use Kelly to determine the overall leverage of the portfolio. So you would scale all the stocks by the same factor as you experience with returns.
So one final question, then we can move on. Lucia asks, for strategies that deliver double-digit Sharpe ratios in production, sampled daily after transaction costs, my experience is that you always hit a hard cap in capacity before you can apply up to Kelly leverage. What would you do in this case? What methods would you use to estimate a strategy's capacity, like, for example, the maximum number of contracts per trade or the maximum capital to allocate in a strategy?
Yes, that's actually I have run into myself. And it's not just a capacity limitation is one reason why we would hit a limit on the leverage, but there's another limit which is most often in this case of stocks is that your broker won't allow you to run the leverage as high as what Kelly recommends. Right? So sometimes the Kelly leverage might say that you should apply 10 times leverage to your equity portfolio, but your broker just refuses. They say that you can only apply up to 6 times, and in that case, unfortunately, sometimes it is better just to put all your eggs into one basket. That is to say, if assuming that you're using Kelly to allocate capital between 2 different strategies, and it says that, okay, you should allocate 5 times leverage on strategy A and 6 times leverage on strategy B. Okay, so the total leverage is 11 times because you have 5 on A and 6 on B. But your broker says that you can only use up to 6 times leverage. Do you reduce both of them, A and B, by the same amount so that you could still fit within this 6 times leverage maximum? Unfortunately, the answer is no. If you want to achieve maximum growth rate, you should just drop the strategy A and just trade strategy B. So you should only pick the strategy that has the highest return if you have a constraint on the maximum leverage you can deploy, either because of the brokerage limitation or because of capacity limitation.
Okay, great. So let's move on, and then I'll hold a couple of questions until the next slide or two.
Okay, great. The other point about the practical implementation of Kelly, besides taking the half Kelly instead of using half Kelly, is that a lot of times we are not only concerned about maximum return, but we are also concerned about controlling drawdown. And remember, the only thing Kelly promises you is that the drawdown won't be 100%, okay? But it could be 90%. You might experience a 90% drawdown, and then the strategy, rebound up to glorious future. That might happen, but it could be one scary ride. So what can we do, in the practical implementation, what can we do to also limit drawdown while we take advantage of this maximum growth rate that Kelly promises? Well, there is a method. A long version of the explanation you can find on my blog. You can go to my blog and search for Kelly formula, and also in particular you can search for this keyword, constant proportion portfolio insurance, CPPI. That is a method where you can apply Kelly formula and be assured that the drawdown will not exceed any number you preset, and I will explain it in the next slide. So CPPI asks you to divide your equity into a safe account and a risky account. The allocation to the risky account is based on your maximum drawdown allowed. So, for example, if you have $1 equity and the maximum drawdown is 20%, where does this 20% come from? Maybe you impose it yourself, maybe your spouse impose it for you, maybe your boss impose it on you. Okay, so anyway, you decided that 20% is the maximum you can lose. Well, what we do is you can put 80 cents of your equity into the safe account. Okay, you won't touch it. You won't withdraw from it. You might add to that safe account, but you will never withdraw it from the safe account. So you will always have 80 cents left at the end of the day. And then you put this 20 cents into your risky account that you are going to trade. Okay, so right away, you see that this setup will never allow you to have more than 20% drawdown, because even if you lose all your money in the risky account, you still have that 80 cents. But that's not all. If that's the case, then we are done. But that's not all. We will trade the risky account, but we will apply the Kelly leverage to that account. So if, for example, Kelly leverage is 5, you will trade 5 times 0.2, which is $1. So you will still trade a portfolio with market value $1 in the risky account. But the Kelly formula tells you that this risky account will never, go to ruin. It will never reach zero equity. So that's great. Now, what happens after you trade one period? After you trade one period, if it is profitable, you can rebalance the capital between the safe versus risky account by withdrawing money from the risky account and put it in the safe account. So let's say after one period, the equity in the risky account might be 25% of the total equity, right? Because you make money. So the weight in the risky account is suddenly higher. Well, we will then need to move cash out, withdraw cash from this risky account, put it into the safe account to restore the 20% balance. Because remember, we said we will never want to have more than 20% drawdown, and maximum drawdown is always measured from the high water mark. It's not measured from the initial equity. So that's very important notion to be clarified. Maximum drawdown is not measured from the initial equity level. It's measured from the high water mark. So you have to keep moving your gains from your risky account to your safe account so that the maximum drawdown from the high watermark will never be more than 20%. Okay, so that's the good scenario. That's when you make money. What if you lose money? If you lose money, don't do anything. What does don't do anything means? Don't do anything means don't withdraw money don't transfer money between the two accounts, but you still have to apply Kelly formula to the risky account, which means that next day your portfolio market value has to be reduced because you lost money in the risky account. By applying the same Kelly leverage, your portfolio market value will be reduced the next day. Okay. But of course, that's the same case if you are profitable. So even if you're profitable, and after rebalancing, you have a new amount in your risky account. You still, even though you withdraw some money from the risky account, the risky account equity still is higher than before. So based on Kelly formula, next day you will still trade a bigger size portfolio. Okay, so let me see if that's yes. So this brings us to the next quiz question. But before I go on the quiz question, let me pause to see if there's any confusion about this this methodology of CPPI.
At the end of the day, when you're rebalancing the risky portfolio, it's only that portfolio is the only one that Kelly's applied to. The Kelly's not applied to the safe, right? So it doesn't. You don't have to change the dollar amounts that you're risking on the safe portfolio. Is that correct?
That is right. The safe portfolio is just a bank account, so we don't trade in it. Yeah.
Gotcha. Okay, there are a few questions.
Okay.
George says that the M and S in the Kelly formula are unlikely stationary parameters in reality. How effective is the Kelly formula in a non-stationary circumstance?
Well, that is very good question, and that is another caveat for Kelly formula, and that is that in principle we should use as long a historical period to estimate M and S as possible. Okay, so obviously any strategy, if you just take a snapshot or take a short period of 3 months, you could be making money. I've heard often that some people's strategy never had a losing day in 3 months. Okay, so that's great. If you apply formula, if you use that 3 months to compute your Kelly formula, it might ask you to apply a 50 times leverage to it. So that is not meaningful. So you should use as long a historical data set to estimate to get a good estimate of M and S as possible. However, sometimes the problem with financial markets is that there's the notion of regime shift. So if you are using data in the 1990s, it might be meaningless because in those days the bid-ask spread might be much wider. There may be there's not all these ECNs. There are not as many quant traders out there. There are no high frequency trading. So if you had used data from that long ago, it will also be meaningless because the estimate for the M and S will not be realistic. The things have changed. So this becomes a rather subjective question. So you have to choose a data set long enough so that the statistics is meaningful, but not too long that it include a completely different market structure. So for example, for me, I would insist on using data that is at least since 2007 to estimate M and S, because that would incorporate certain financial crisis. But using data before 2007 is not particularly useful because a lot of the high frequency traders come into play around 2007. A lot of the market regulations change around 2007 and 2008, so it might not be relevant anymore. So it is true that M and S changes, but we are hoping that the long-term estimate of M and S within the same regime will not change. So obviously, if you are only using 1 month to estimate M and S, it will change radically. But that's not advisable for your estimation of Kelly.
Gotcha. On the risky account, are we using half Kelly or?
In the risky account, you can use Kelly because even if you are over levered, the worst it can happen is to lose all your money in the risky account. Okay. You are still within your maximum drawdown. Okay. So I would be comfortable using the full Kelly. Gotcha.
And Mike asked the question, is using half Kelly based on anything in particular, or could it just as easily be 2/3 or 1/4? Is it calculated from something else? And also, have traders using half Kelly been wiped out?
Well, the second question, I can't, I don't know all the traders in the world, so I don't know if they have been wiped out. Theoretically, of course, you can still be wiped out. For example, one day, if you invest all your money into one stock, okay, and that one stock has been behaving very well, and you are using a Kelly, half Kelly of 2 times leverage, and then that stock like N1, okay, right, suddenly just go to bankrupt, obviously you'll be wiped out. So certainly there are cases where if you are undiversified, it can happen. Right?
But if you have a diversified portfolio, then the whole point of Kelly is to prevent that.
That's right. If you're trading futures, which is much rather unlikely that crude oil will suddenly go from $100 to 0 in one day. Right. So, but the first part of the question I don't quite understand.
He's saying that you're using an example of half Kelly. If let's say that he's more risk averse or less risk averse, can he change that to 1/4 Kelly or 2/3 Kelly? Is that something that's adjustable?
Well, the half Kelly or 1/3 Kelly, that becomes a sort of arbitrary, right? I mean, obviously, if you are using 1/3 Kelly, it's safer than using half Kelly. But then the next guy come along and say, why don't you use 1/4 Kelly? You know, obviously, the lower the leverage you use, the less risk. But then you'll be farther and farther away from
the optimal, right.
optimal growth.
Gotcha.
So that's the problem.
A couple more questions. Andre asks, if you could start again, would you still go for a job in the finance sector, or would you become a private trader from the beginning?
Well, that's okay. So let me. It's hard to say, you know, but there's one way I can answer it, which is that I haven't learned very much working in the financial industry that is relevant to trading.
Okay.
So yes, I would guess that you know, it's that okay. But there's one positive aspect in working in financial industry is that it builds up your equity.
Right.
So if you have no equity, you can't trade. So that's quite simple.
Right.
But on the other hand, from the knowledge point of view, it doesn't help very much.
Right.
Yeah.
Okay, another question. Andres says, isn't both the half Kelly and the CPPI just subjective adjustments to Kelly? I think we just talked about this. Meaning that any logical adjustments would be equally valid, or maybe these two methods have something more concrete behind them.
Okay, so the only reason why I introduced CPPI as a modification of Kelly formula is because in practice, okay, if you are just one single guy, okay, trading your own account, nobody looking behind your, you know, over your shoulder, forget about CPPI. You can take a 90% drawdown. You know, nobody will bother you if you have a 90% drawdown. So you just adopt Kelly with the goal of maximizing your equity. But if you have somebody looking over your shoulder, your spouse, your boss, your manager of your trading group, and they tell you that if you're down more than 20%, your career is over, then you are forced to adopt CPPI. Yes.
And if the same person, if most of the standard deviation is on the positive side of the Gaussian return function, doesn't Kelly unfairly punish the strategy? Like, for example, it will suggest a lower leverage than it should.
Yes, that is in fact true. Yes, if you have a positive skew and kurtosis that positive skew and a non-zero kurtosis, yes, Kelly will under-lever. That is true. It's just like the mirror image of the case which is more normal, where the strategy had a fat tail in the negative end, then Kelly will over-lever. Yes, correct.
Okay, two remaining questions, then we can move on. Jonas asks, how does one take into account the possibility of a flash crash in a leveraged account? That could, after all, lead to negative equity in the risky account. So he's talking about like futures. I don't really know. I mean, I think that in the past there were certainly examples of negative equity, but I think that most modern, I assume it's possible, but most of the time, most modern brokers will simply close the position. They're not going to wait and issue a margin call. I guess it depends on your account and your relationship and who you are. So do you have any comment on that?
Yes, this somewhat get into the legal territory, and I asked a similar question to Ed Thorpe, one of the the sort of luminaries in the exposition of Kelly formula, and he said basically you should trade through a LLC so that you limit the liability.
Right. So if it's negative, then you just walk away.
That's right, yes.
Okay.
Go ahead.
Arendam says, how does Kelly change in very volatile environments, like, for example, during 2008?
Yes, interestingly, I have done some Monte Carlo work and using these extreme data, and and to my surprise, for some of the test strategy that I fitted in, it recommended leverage that is Kelly, assuming that everything is Gaussian, recommended leverage that is not too dissimilar from a brute force optimization of leverage. So yeah, it's actually fared pretty well. But there's one thing is that one should pay attention to. Is that if Kelly recommend a leverage so high that on a day when you think your price can move 20%, and let me make it very simple. If Kelly recommend a leverage of 5, and you think that in one day your portfolio could have dropped 20%, perhaps because you are trading S&P 500 futures, and it did experience a 20% drop in one day. So if you leverage 5 times, obviously you'll be wiped out on that day. You don't need Kelly formula to tell you that. If you are levered 5 times,
right.
So you do have to apply certain common sense to it, because
sure.
That's all I have to say.
Okay, so let's hold questions and go ahead and go to the next slide.
Okay, good, great. Okay, so let me say that the next slide is a quiz. Okay, so suppose you have a strategy trading just one stock, okay, and this is a question about CPPI. So you start with a total equity of 100K, and your maximum drawdown is 20%. So that's something that is arbitrary. You decide that your maximum drawdown is 20%, and Kelly leverage is 10. Okay, you think you had a great strategy, so you had a Kelly leverage of 10, and your profit after one day was $20,000. Okay, so what should be the order size for that stock the next day if you are practicing CPPI?
Okay, as the answers come in, I'm going to read them out. K-Star says 2.4K.
Let me clarify. Do you mean 2.4K, or you have some digits after that?
He's written only 2.4.
Okay. All right, then it's not right.
JP says 25. Rhino says, oh, that's unrelative. Kevin says 600. A different Kevin says 20,000. BP says 240K.
Correct.
Okay, yep. So BP, I need your BMT username, and then Ernie, you can explain.
Okay, so after one day, after making this 20K profit, the new equity is 120K. Now, 120K is the total equity, including both the risky account and the safe account. Okay, so we said that the maximum drawdown is 20%, so the risky account should have 20% of this new equity. So 20% of 120K, let's pull out our calculator, 120 times 0.2, that is 24K. So the new risky account equity should be 24K. And remember, our Kelly leverage is 10, so you should leverage this 24K equity 10 times to give you a 240K
right.
portfolio, or more order size, because the portfolio has only one stock, so the order size is 240K.
So congratulations, BP, on winning a book. We still have 3 more books to give away, and I want to go back to Peter's question before we move on too far. Peter says, I'm using Kelly in a different way for trade selection. For example, he's using 12 possible strategies on multiple baskets of instruments like the NASDAQ 100 or the S&P 100. And so overall, the strategies are back-tested and profitable. And when it triggers the possible trades of the day, he will select the trades with the highest Kelly factor. So he will only trade the best historical odds. This keeps him from keeps him inside the capacity constraints when too many trade ideas are triggered. Do you agree with that?
It's a rather complicated scheme. I don't know that I have all the moving parts figured out in my brain. So, yeah.
So that's one of those things that Peter maybe can email you later and get your comment on.
That's right. Yes, please email me. Yeah.
Okay. So no other questions. Does anybody have any other questions on this slide about how we reached 240K?
Okay.
All right. I don't see anything else, so let's move on.
Okay, great. So So this slide is sort of just emphasizing what I have been talking all along. The Cayley leverage that m divided by s squared, that is optimal only. This simple formula is optimal only when the returns are Gaussian. If you assume a non-Gaussian distribution, or then the formula won't be so simple. Although you can still do a brute force optimization of the leverage. So the question is, as I said, how close is this simple formula to the actual optimal when you do this brute force optimization? And what I find out is that actually the answer is pretty close. So that's what I've been emphasizing. The simplicity of this formula, that does not really diminish the closeness of the approximation. A simple formula is actually give you an answer pretty close to a brute force method or other complicated methods. So that's the beauty of this formula. Okay, so now finally we move on to capital allocation. There's some of you have asked earlier if you have multiple strategies that they are correlated, their returns are correlated. How do you allocate leverage to the different strategy? And here's the formula. F equals C inverse C M. So this is a matrix equation because F is become a factor because now you have multiple strategies, 1 to n. So F1, F2, and Fn are the optimal leverage for each strategy or each portfolio. The T simply means the transpose, matrix transpose. It's not important. C, this is the covariance matrix of the returns. Okay, and you can compute it using even Excel, but usually MATLAB is the easiest platform I use to compute the covariance matrix of the returns. So you have to compare every pair of returns. How often does the strategy 1 have the same positive return as strategy 2 and strategy 3, and how often the strategy 2 has the same return as strategy 3, that sort of numbers. So it's a matrix, and then M is also a factor. Capital M is also a factor, but that is the vector of average excess return of each strategy. So if you just compute this covariance matrix, takes the inverse and multiply it on this, apply it to the vector M, you get the optimal leverage on each separate strategy. Okay, that's assuming that you want to use Cayley formula to run capital allocation, and you do not have your own capital allocation based on your own strategy. So this formula not only tells you what the relative market value is, but it also tells you what the overall leverage is. Because what is the overall leverage? The overall leverage is simply the sum of the absolute value of the individual leverage. Okay, that's the overall leverage of the combined strategy. So some of this leverage might be negative, meaning that you should be shorting the portfolio, or maybe you should run the opposite of strategy. So you have to take those the absolute values of these numbers before you sum them, and that gives you the overall average. Now, so here's an example. You can construct a portfolio of 3 ETFs. One is OIH, is the oil service sector ETF. RKH is a regional bank ETF. RTH is a retail ETF, and that's actually an example in my book. If you look at the in my book on the chapter on money and risk management, you will find this example. If you run this methodology, the matrix equation that I wrote on data between 2000 and 2007, you would find that the optimal average is 1.29, 1.17, minus 1.5. The minus sign, again, means that you should be shorting the RTH ETF. Okay. So I didn't, go into the nitty-gritty arithmetic details or the mathematical details of how to do the matrix calculation, but it's something that you can do quite easily in MATLAB. So before I go on, let me see if there's any question on this capital allocation formula.
Arindam says if you have a strategy, I'm not sure I understand. If you have a strategy 3 out of strategies 1, 2, and 3, with strategy 3, F equals -1, do you just run that strategy? do you just not run that strategy?
Okay, so let me interpret the question. So right now we have this negative 1.5 for the strategy. So is the question whether you should just drop the RTH? Let's say RTH is a name for a strategy, not an ETF. So you can't really short a strategy sometimes.
Yes.
So you just drop it.
That is his question. But the way I understood, you said just to go short instead of not running it at all.
Well, you can, yes. You
Okay.
can go short an ETF, but to go short a strategy, there's a problem. Because oftentimes the strategy is negative because of transaction cost. So just by shorting a strategy, you don't get, so the strategy after transaction cost
Gotcha.
give you minus 1.5. But
Right.
you run the opposite strategy is not going to give you plus 1.5. The
Right.
transaction cost must still give you
remain the
negative.
same.
So that's a
Right.
problem.
Okay.
So what I would recommend is if you find a carry allocation for a strategy to be negative, indeed drop it, but you have to rerun the capital allocation formula for the remaining two strategies to find a new optimal ratio. Okay, so the old ratio no longer applies when we only have two strategies left. Okay.
Doesn't seem so. Doesn't look like it, so we can move forward.
Okay. So, all right. So, one final sort of caveat, let me say, about using carry for capital allocation is that covariance estimation is often inaccurate. And it's inaccurate because a lot of times when you apply this to strategies, not portfolio, one strategy may not be trading many days. So you would get zero return. So a lot of days you would have zero return on one strategy and non-zero return on another one. So there are rarely situations where you have, maybe it's not often that both strategies has return. So the covariance estimation can be very bad because you hardly can estimate covariance when both, the two strategies do not simultaneously trade and do not simultaneously have non-zero return. So oftentimes, you might simplify it by just sticking in 1, 0, or -1 into this covariance matrix, depending on whether the two strategies you think are very closely related. Maybe they're just variations of the same strategy, or whether they're opposite. One is a momentum strategy, one is a mean reverting strategy. So if one is positive, you think the other one must be negative. So you might just arbitrarily assign 1, 0, -1 to the covariance matrix. They might give you a better answer than to just rely on backtest, where some of these strategies may not have simultaneous return on the same day. And the second caveat is something I mentioned before in reaction to one of the questions. If your brokerage margin limit is much lower than optimal OF, or if you are capacity limited, you'll find that it might be optimal to get rid of this capital allocation and just put all your eggs into one basket and just invest in the strategy with the highest average return. Okay, so for those of you who are interested in more details on carry formula and the application, you can go to this website by Edward Thorpe. He has a much more mathematical exposition of all these issues I talk about. Okay, I don't think there is much to comment on this slide, so let me just move on to the next one. Limitations. Okay, so I emphasize Gaussian assumption is one big limitation. It can underestimate probability of large loss. So in many cases, you can use Kelly formula only as a upper bound on your leverage. So if Kelly says that 5 is the optimal average, make sure that you don't exceed 5. But you can certainly use 2.5 or use 2 if you're nervous. But it basically tells you that you should not go above 5. So you can regard it as an upper bound rather than the actual number you should use. And despite the fact that Gaussian assumption might be wrong, capital allocation might still be valuable because you just have to make sure that your overall leverage is smaller than what the Kelly formula tells you, but you can still use Kelly formula to allocate leverage amongst the different strategies. Now, there's one more caveat about Kelly formula is that it is a situation where if everybody manage risk according to Kelly formula, it can actually lead to a contagion. And that actually happened in 2007, where in 2007, there are a lot of funds which are hybrid funds. They have a mortgage-backed security portfolio and they have a set-up portfolio. And they lost a lot of money on the mortgage portfolio. So because of California, they are forced to sell into the loss to reduce, to reduce their portfolio size in order to maintain the same leverage. But their mortgage-backed security portfolio is very illiquid. So instead they cut back on the set-up portfolio. And because one fund is cutting back on the set-up portfolio, it depresses the prices of the long stock and it raises the price of the short stock. It costs another hedge fund which has a similar setup portfolio. A lot of these setup portfolio have a high correlation. They all long the same stocks and they all short the same stocks. So if somebody's liquidating the setup portfolio, it will cause losses in somebody else's setup portfolio that holds similar stock. And because of California, they will have to reduce the size too. So everybody, in other words, are selling at the same time for the same stocks because of this risk management scheme, and that can lead to contagion. And that is actually what happened in the summer of 2007, where many of the big startup fund loses.
So if you Ernie, if you look at like AIG, for example,
yes.
Okay, would you say that their whole problem was simply lack of diversification? I mean, the reason that they failed and required a bailout is because they, like you just said, this contagion and it depressed the prices, and everyone was coming to them. They had too much of their eggs in one basket for the insurance payouts? Is that a good explanation? They were over leveraged in that industry.
Well, AIG certainly is over leveraged, but their problem is a little bit different from these startup funds because they actually hold mortgage-backed securities and they are short options essentially, right? They are insurance, so they are writing options, so that's a very risky position. And the reason they collapse is A, because they're writing options, B, because they are over leveraged, and C, because it's not diversified. But
right.
for this startup funds, the reason they had a big drawdown is not because they are over leveraged, and it's not because they are undiversified, and it is purely because they are all holding similar positions as each other, and so whenever one fund loses money and liquidate portfolio, everybody had to liquidate.
But I mean, in terms of AIG requiring government assistance to keep the doors open, they could have as many risky, they could have as much risk as they wanted on the mortgage-backed securities, as long as it was only a certain percentage of their overall business portfolio, right? And it still wouldn't have bankrupted the company. So
that is right, yes.
In my eyes, it was simply I would classify it as lack of diversification. They put too much risk on this side of their portfolio, which caused everything else in their business to, not be able to be enough to, keep the doors open. And
yes,
the same thing is true for an individual trader. If you love Apple and 80% of your portfolio is Apple, or maybe it's made up of Apple suppliers, like Foxconn or something, and something happens to Apple, that's just simply lack of diversification on your part that would cause, substantial losses.
But that's right, and that is actually related to our earlier discussion about whether California is a good estimate. If you have an undiversified portfolio, it's not going to be a good estimate because the tail risk is simply too much, right? So that makes it quite useless to actually apply California.
And the same thing we talked about earlier on correlation too being an important factor. Okay, so Andre asked the question, in describing a business case for quant trading, you mentioned in your book that someone with alternative skills should ponder whether quant trading is the right path. What skills do you find most useful for a quant trader, and what alternative skills in your mind would switch someone out from quant trading?
Well, quant trading is not all that different from other type of trading, discretionary trading. Both of them, the essence of success is that you have to understand the market. You have to have a fundamental understanding of the market. Just because you are a good programmer or a good mathematician will not make you profitable. Okay, that's I've found, I've learned the hard way. So the prerequisite of being a good quant trader is the same prerequisite of being a good discretionary trader. But the difference between a good quant trader and discretionary trader is that the quant trader will have the programming skills to turn their intuition and knowledge into a program so that it eliminates emotions, it eliminates mistakes from ongoing operation of that trading strategy. So it's become a more disciplined sort of a trading methodology than discretion. So I think so the additional skills beyond what a discretionary trader needs is obviously just being a good programmer. The math required is very minimal. I think that anyone who have finished one freshman year of college in statistics and linear algebra could tackle any sort of quant trading strategy pretty well, unless you are into derivatives. But for cash equities or for futures, there's no advanced math that's needed. So programming is much more important for that transition.
Right. Okay. I don't see any other questions, so I think we can go ahead and go to the next slide.
Okay. So actually, my formal sort of presentation is over, and I have 3 more quiz questions coming up.
Awesome.
So the question 3, we are long one stock. Okay. Let's say we are long a stock in our account. And let's say the Kelly leverage of this stock is 0.9. Okay, so this is remember, it's less than 1. It tells you to be conservative. After 1 day, the stock price dropped. The question is, should we buy more shares the next day, or should we sell some shares according to Kelly formula?
Okay.
A good way to calculate this is to construct a numerical example for yourself.
K-Star says sell, and Kevin also says sell. Sanad says drop. Andre says sell, and Stacy says buy.
Okay, that's great. Stacy's right. Okay, so let me explain. Let's do an example. Let's say your initial equity is $10,000. Okay, 10K, and your stock market value based on the Kelly leverage is 0.9 times 10, so that's 9K. So the stock market value is 9K, which is less than your initial equity. Rather unusual, but that's what the example says. Now you lose $1,000, lose 1K, so the new equity is what? The new equity is 9K, right? Because your initial equity is 10K, so you lose 1K, the new equity is 9K. What is the new target market value? The new target market value is 0.9 times this 9K of equity. That is 8.1K. Okay, so the new target market value is 8.1K. But remember, the actual market value was 9. So I'm sorry, the actual market value is 8 because initially the stock market value is 9K. We lost 1K, so the actual market value is 8K. So the new target market value is actually higher than the actual market value. So you need to buy some stocks in order to get up to 8.1K. So this is an unusual case because the Kelly leverage is less than 1. So you only want to sell into a loss when the Kelly leverage is greater than 1. If Kelly leverage is actually less than 1, you actually do the opposite. If you lose money, you actually have to buy more stocks.
Okay, great. So thanks. Congratulations, Stacy. So we still have 2 more books after this. And I have one question from the presentation before we do more quiz questions, Ernie.
Okay.
Ernest asks, what if you have a low vol environment strategy, so low volatility environment strategy? I don't know if he means low volume or low volatility. And the other is a momentum strategy that does well in a high volatility environment. Okay, so currently in a low volatility environment, because of recent history, the strategy Kelly will give more leverage to the low volatility performing strategy. However, regime change studies show that low volatility is followed up by high volatility environments. So as a trader, you might want to allocate more to a high volatility strategy. Is that analysis correct? I hope you followed that.
Well, I think I follow the overall gist of it. I think the thing to remember is that M divided by S squared. Okay, that gives us the Kelly leverage. What is M? M, you can estimate it using history, but that is seldom right. If you think that you have an insight that, for example, you think that volatility is mean reverting, and because you're expecting a high vol regime going forward, well, your estimate of M can be higher. So that becomes a bit arbitrary, because if you think that you can make a better estimate of the expected return than just using historical averages, go ahead. Use that, your proprietary estimate, and stick that into the Kelly formula. So naturally, if you have a higher expected return for that strategy, you will come up with a higher Kelly leverage. So it's all a matter of what your expected return and what your expected variance of return will be. You might have a very sophisticated method of estimating that, much better than just simply using historical averages.
Okay. All right, so I don't see any other questions, so you have another quiz question for us?
Yes. Question 4. If you have a portfolio of 3 stocks and you have uncorrelated returns, all of them have the same expected returns, what are the statistical attributes of these stocks that will determine their relative allocations? Okay, so remember, you have a portfolio of 3 stocks. They are uncorrelated, and they have the same expected returns.
Is this a...
What other attribute will determine their relative allocation?
Andres says standard deviation.
That is correct.
All right. So congratulations. I know we have multiple Andres in the room, so I'm going to send you a private message there so you know which one it is. And I need your BMT username, please. Okay, so anyone have questions on how we came to that answer? Jonas says no, it's the variance. No, it's the variance of S to the second.
That is true, but well, variance and standard deviation are related by, as you said, the square. So
he says just joking. Okay, so all right, so congratulations, Andres. We still have one more book, so let's go to the next slide.
Okay. If you're trading just one stock, what's the benefits of maintaining Kelly leverage? There are multiple answers. Just give me one benefit.
Okay. Andrew, a different Andrew, says maximize profits. Lucia says no risk of ruin.
Okay, I think I like the second answer better.
Okay. So, Lucia, I need your BMT username, please.
The maximize profit is a bit iffy, because I would prefer you to say to maximize the long-term growth rate, because
Okay. I figured that was going to be you. All right. I'm talking to Lucia. I was hoping he was in the webinar today. Okay. So does anybody have any other questions that we did not already answer? And Ernie, do you have like a contact slide or any other slides that you want to show us today?
Yes, like I said, if you have any questions, do feel free to email me, or you can comment, go to my blog. There are lots of comments. There are a lot of user-generated content on that blog from different traders. So feel free to post your question on the comments of the relevant blog posts. I monitor all my blog posts in the past few years, so feel free to comment on something that I wrote 3 years ago. And you can go to my main website, epchen.com. Has some information, but there's a premium content section that is for people who has my book. They have the password to log into, but otherwise you can go to my blog. Okay. And so enjoy my book if you have read it.
Okay, so we have several questions. Andres asks, Ernie, in your experience, do you suggest for a retail trader to use Kelly or half Kelly?
Half Kelly for sure, yes.
Right, okay.
Unless you're using CPPI, in which case you can apply full Kelly to the risky account.
Okay. Sanat asks, can you tell us more about the second book, what the topic is, or any details?
The second book has covered a lot more on futures strategies.
Okay.
Yeah, and it's basically had a little bit more higher math, require a little bit more math.
Okay. Well, that's great. So, Ernie, I'll go ahead and officially ask you to come back maybe in June for our 4-year anniversary. Maybe that'll coincide roughly with the release of the book, and we can give away some books.
Okay, great.
Andre asks, what do you think about the top finance-oriented MBA programs out there? Do you think they could prepare someone better for a successful quant trader path?
Well, from what I understand, a lot of the finance MBA programs are focused on derivatives pricing. They use a very complicated mathematics, and most of which are not particularly useful for cash equity trading. But I do see, for example, that Columbia University has a substantial step up. I like the stuff that come out from the seminar. So a lot of the professors produce good stuff. So Columbia is a good choice. But I'm not familiar with the program at other schools simply because I've never attended their seminars. I'm not saying they're bad. I can only say that I like the seminar from Columbia, and I think they have a very decent finance MBA program.
Okay. And Lucia is commenting that he wants to add to Andre's question that MIT has a strong buy-side quant program nowadays. Okay.
That's great.
Ryan asks, do you do any kind of private consulting, like if he wants you to write scripts? I don't know if he's talking about MATLAB or whatnot.
Yes, I do. Yeah.
Okay.
You can send email me.
Okay. George says, since the retail traders are more nimble than the institutional traders, do you think that the retail traders should trade differently than institutional traders?
Yes, there are a lot of niche opportunities that have very low capacity, and institutional traders won't be interested in them, and those are areas that retail trader can benefit.
Right. Lucia asks, since the returns are not a Weiner process, hope I said that correctly, your Kelly average is going to be unstable with respect to the sampling interval of your mean standard deviation. The numerical differences are significant if your holding periods are short. It distorts your VAR as well. Would you sample your returns daily? And also, do you prefer to sample realized or unrealized returns?
Okay, so yes, I sample it daily, but like I said, if your Kelly leverage is high, you have to sample more frequently. Okay, certainly I use the total return, or for my estimation, both realized and the unrealized part.
Okay. Jonas says, when using multiple strategies, the drawdown of one will influence the growth rate of the others on the same account. Does it make sense to split the accounts, like one for each strategy?
Yes, that is a judgment call. What I have found is that you do want to separate the different strategies sometimes. You don't want the best strategy, the good strategy, to subsidize the best strategies. If the best strategies keep losing and reach maximum drawdown, you should just shut it down rather than keep moving money from the good strategy to subsidize it. So I actually prefer having different accounts for the different strategies.
Okay. Andre says, it's kind of unrelated to Kelly, but what would Ernie suggest to a beginner quant trader to focus on? Is it to build knowledge towards becoming, what would you suggest to focus on to build knowledge towards becoming a trader?
Well, one should always read about, books, blogs, and all kinds of stuff, and at the same time, try to backtest simple strategies. There's no harm to backtest a strategy and paper trade it, and if it doesn't work, figure out why it doesn't work. Why is the reality so different from the backtest? Once you figure that out, you will vastly improve your intuition about what a good strategy is.
So let's talk about backtesting for just a second. Ernie, do you use MATLAB predominantly, or TradeStation, or some other platform?
Yes, I do use MATLAB predominantly, but that's just me. I'm familiar with MATLAB, so if you are familiar with TradeStation, by all means use TradeStation.
Okay. Peter's asking regarding quiz question 3, the Kelly leverage is less than 1. Is that still a positive expectation?
Oh yes, it just said that it just happened that the variance might be very large, compared with the mean, so that makes it less than 1.
Okay.
But it's still positive. Yeah.
Andre asks, were you always successful within your private trader history, or did you also have some bad years? And can you tell us what kind of mistakes that you made?
Well, I had the first year I became an independent trader, I had a losing year due to one strategy, one pair to be precise, and that is the XLE crude oil pair. And I lose money in that because I didn't understand the notion of roll return in futures. I can go on all day about that, so let me not do that. But after that, my total return, the return including my private trading plus my fund plus managed accounts and so forth, they all have been positive since that year.
Okay. Lucia asks, he's noticed that you spent some time with hidden Markov models. If there's no conflict of interest with your clients, can you tell us if the approach is promising?
Well, to be frank, I have indeed I have tried a lot of times on trying to see if it's useful in finance, and I have never succeeded in making it work.
Okay.
So.
George says, if past performance does not indicate future profits, how useful is backtesting? That's always a common question.
Yes, and I think there's a good answer from one of the commenters on my blog, and that is that it can reject a strategy. It may not be, if your backtest is good, it may not mean that the live trading is good, but if the backtest is bad, you can forget about the strategy. So, yes.
And I find personally that it also gives you, it sets forward some expectations, right? So if you start live trading or paper trading this strategy and you're way outside the boundaries of what it was doing in a backtest, that's a pretty good idea that it's not going to conform to, your overall profit goals.
That's right.
Okay, so George, or we just did that one. Lucia saying also regarding curve fitting, one of your favorite recommendations is to reduce the degrees of freedom in the parameterization of the strategy. Could you suggest some other more advanced means? So he's saying that, instead of to get rid of or lessen curve fitting, is there any other means other than reducing parameterization?
Well, there are ways such as what they call it, the cross-validation. You pick different samples out of the data, and then you want to make sure that the parameter is optimal in every subset of that data. So that's one way to make sure that it's not overfit. But in general, I have not found this kind of optimization, no matter what precaution you take, to really fully avoid this problem of curve fitting.
Are you talking about like an out of sample, like a walk forward test?
Yes, you could. One way is to walk forward test, but walk forward test doesn't help you to determine the parameter. The optimal parameter, you have to determine the optimal parameter in the past.
Right.
But the thing is that you can subdivide your past into different subsets to make sure that your optimal parameter is optimal in every subset.
Gotcha.
Excuse me, or most subsets.
Okay. Yeah. Okay. I don't see any other questions, so I think that at this time, I want to thank Ernie for a really fantastic presentation. I'm sure that a lot of people will be watching this in the future and to great benefit. If anybody has any further questions, they can contact Ernie through his email address. You see it right there on the screen. He also has his website and his blog right there. And be sure to check out his book on Amazon. It's Quantitative Trading, if you weren't one of the 5 lucky people today to win one. And to those guys, I will be sending you a private message later today, and I'll get the info and we'll get those books in your hands. So I'll post the recording for this webinar sometime tomorrow on BMT in the usual spot. I will send it to Ernie as well, so he can send it out to his guys if he wants. So thanks, Ernie. I really appreciate it, and I hope to have you back in June perhaps for our 4-year anniversary. Maybe that'll coincide with your second book.
That's great. Okay, thank you all for attending. Have a great evening.
Thanks, guys. Thanks, Ernie. Bye.
Bye.
The organizer has